Welcome to this explainer. Look, I know exactly why you're here. You can hear that clock ticking, those exam dates are looming, and the pressure? Yeah, it's officially on. But hey, take a deep breath, because today we're going into high-yield revision sprint mode. We're going to strip away all the fluff and focus purely on the core principles, the exact frameworks, and the absolute most dangerous exam traps across advanced financial management, performance management, and taxation. So get ready to focus. This is your last-minute survival guide.
Here is the survival blueprint we are tackling today. We've got advanced finance and valuation, measuring business performance, navigating UK taxation rules, avoiding common exam traps, and finally, the winning exam strategy.
Before we really get into the weeds, I want you to lock this quote from our source material into your mindset. You will learn more from your mistakes than from any notes. See, we aren't just rote learning formulas today. No way. We're here to learn exactly where other people mess up so that you can succeed when you finally sit down in that exam room. Section 1, Advanced Finance and Valuation. Okay, so what's AFM all about? Well, if you need a punchy one-line trigger to lock in the core of the syllabus, it's exactly this. Advanced investment, financing, risk, and valuation decisions. We are way past simple net present value here. We're looking at the messy, real-world side effects of how a project is actually financed. And this brings us to adjusted present value, or APV. And the procedural flow here is absolutely critical. APV forces you to separate the operating MPV from the financing side effects. Think of it like a puzzle. Step 1, you find the base case NPV using an all-equity assumption. That's your ungeared cost of equity. Then, and only after you secure that base, you calculate the present value of the tax shield on debt. Finally, you add or subtract issue costs and subsidies. The step-by-step separation, it's a total game changer. You have to do it. Now, you've got a whole toolkit of valuation methods, but the crucial point is you must know exactly when to deploy each one based on the specific company type in your exam scenario. Got mature, predictable cash flows? Use DCF. Does the company have a really stable dividend policy? The dividend valuation model is your go-to for sure. Looking at comparable quoted companies? Bring in the PE ratio. Asset-based is strictly for holding companies or breakups, and EV/EBITDA, that's perfect for companies with high depreciation. Basically, just make sure you match the tool to the target. Section 2, Measuring Business Performance. So, APM is a massive shift in how you need to think. We are not just looking at short-term financial variances and simple standard costing anymore. We're talking about strategic performance management, behavioral issues, integrated reporting, and advanced measurement frameworks. It's really about how measurement impacts human behavior, and ultimately, how to drive long-term shareholder wealth. Let's put traditional costing and activity-based costing side by side. Traditional costing assigns overheads using a single volume measure, like labor hours, right? Well, that can dangerously over or undercost complex products. ABC, on the other hand, is so much smarter. It assigns overheads using multiple, highly accurate cost drivers, like the actual number of setups or inspections. It tells you exactly what activities are driving your costs. When it comes to non-financial performance, Kaplan and Norton's balanced scorecard is literally legendary. It forces you to look way beyond just the financial perspective. You have to ask the tough questions. How do our customers actually see us? What internal processes must we excel at? How can our people learn and grow? The real magic here is the cause and effect linkage. Think about it. Learning and growth drive internal process efficiency, which drives customer satisfaction, which ultimately hits that financial bottom line. Every measure you recommend has to link directly back to the corporate strategy. You need to heavily contrast return on investment and residual income in your mind. ROI is expressed as a percentage, and honestly, it can cause some dangerous sub-optimization. What I mean is, a manager might reject a perfectly good project just because its ROI is slightly lower than their current average, even if it beats the cost of capital. That's crazy, right? Residual income, however, is an absolute monetary amount. If a project generates positive residual income, it adds value, period. It totally aligns a manager's decisions directly with what's best for shareholder value. Section 3. Navigating UK taxation rules. Okay, we're pivoting into the strict, uncompromising world of tax now, where precision is literally non-negotiable. Lock this one-line summary in your head right now. Income minus deductions minus the personal allowance equals taxable income. Then apply the rates in order. That is the universal structural flow for every single income tax computation question you're going to face. You sum up all the income, subtract allowable deductions like your pension contributions, subtract the personal allowance, which is £12,570 for the 25-26 tax year, and boom, you've got your taxable income. You absolutely need to take a mental screenshot of these exact bands. Applying these 2025/26 rates in the strict order of non-savings income first, then savings income, and finally dividend income is your guaranteed path to maximum marks. Keep in mind, dividends have their own specific lower tax rates. The basic rate band goes up to £37,700, and you always fill that bucket with your non-savings income first before moving on to the others.
When you're calculating trading profits, remember this golden rule. HMRC does not care about your accounting depreciation. It's totally disallowed. Instead, you have to aggressively claim capital allowances to successfully minimize corporate or income tax. The annual investment allowance gives you a massive 100% deduction on qualifying plant and machinery up to £1 million. After that, you're dropping into the 18% main pool or the 6% special rate pool. Know these inside and out.
Section 4. Avoiding common exam traps. All right, wake up and focus. We are entering the examiner's mind right now to dismantle the traps that literally kill passing scores. Trap number 1 is in advanced financial management. When you're calculating your base case NPV for an APV question, do not, I repeat, do not, use the WACC. If you use the WACC, you're double counting your tax shields. You must always use the ungeared cost of equity for your base NPV, assuming the project is entirely equity financed before you manually add in those financing side effects. Trap number 2 is in performance management. Please never mix up your planning and operational variances. Planning variances compare the original standard to a revised standard. They basically forgive unrealistic standard setting caused by market changes you can't control. But operational variances, they compare the revised standard to actual performance. This is what holds the manager strictly accountable for what they can actually control. Don't get them twisted. Trap number 3 is a big one in taxation. When you're calculating inheritance tax, do not just blindly apply the £175,000 residence nil rate band to every single estate. That allowance is highly, highly conditional. You can only claim it if a main home is specifically passing to direct descendants. We're talking children or grandchildren here. If the home is left to a sibling or a friend, that allowance completely vanishes. Section 5. The winning exam strategy. You've got the technical knowledge now, so let's talk tactical execution. This is your daily coaching regimen from right now until exam day. You have to practice under strict time pressure. Attempt your MCQs with a timer actually running. Get onto the ACCA practice platform and do full mocks. And listen to me, never hit the pause button. When you make a mistake, isolate that concept gap, figure out exactly why you were wrong, and ruthlessly fix it. And here is the final, ultimate rule across all these exams. State assumptions clearly, show all workings, link calculations to strategic advice. The examiner practically hands out method marks for your workings, even if your final number is totally off because your finger slipped on the calculator. Show your steps. Plus, in the advanced papers, a naked calculation is useless. You must link every single number back to a commercial strategic recommendation for the business. So we've covered the advanced valuation frameworks, the strategic alignment of performance management, the non-negotiable tax rules, the examiner's absolute favorite traps, and exactly how to practice effectively. You've got the tools, you've got the structure, and you've got the strategy. The only question left is, when you sit down in that room, are you going to let the pressure crush you, or are you ready to trust this process, execute, and finally pass this exam? Get on that practice platform, start the timer, and let's make it happen.